Welcome to Growth Gurus, where learning never stops. Today, we are diving into the world of mutual funds and discussing the key factors you should consider when choosing the best mutual funds for optimal returns. Mutual funds are a popular investment choice, offering diversification and professional management. But how do you choose the right mutual funds that align with your investment goals? There are several factors to be considered. The first factor to consider is the fund's performance track record. Look for consistent, long-term performance of fund and compare it to the fund's benchmark index. Now, the question arises, what is benchmark index? So, a benchmark index, also known as a market index or stock market index, is understood as a statistical measure that represents a specific segment of the financial market. Depending on type of fund, different benchmark index are there. For example, to track performance of large cap companies in India, the benchmark index can be Nifty 50 and Sensex. Now, quickly let's understand large cap companies. Large cap companies can be all company having market capitalization above 20,000 crore rupees. Whereas, Nifty 50 index considers the top 50 companies and Sensex only considers the top 30 companies based on market capitalization in India. Next factor to be taken care of before investing in mutual fund is the fund's expense ratio. Expense ratio is defined as charges for management of funds. Thus, lower expense ratios mean more of your investment goes toward generating better returns. Investors should be cautious of funds with high fees that can eat away their profits. Another critical factor to give due weightage is the fund manager's experience and expertise. Every individual have its own unique personal characteristics like education background, personality traits, investment outlook, and the like, which may have impact on potential returns of the funds. Researching the manager's track record and investment philosophy to ensure it aligns with your own goals will be crucial in generating returns. Next, diving deeper, consider the fund's investment strategy as another factor. It should be aligned with your risk tolerance level and investment objectives. The investment strategy is how asset allocation is carried out. It may be of different types like conservative, aggressive, defensive, value investing, or growth investing. Thus, your fund's investment strategy determines your potential for returns. Another factor is the fund's asset allocation. Is your asset allocation provides the desired level of diversification? Ensure the fund's holdings are spread across various sectors and asset classes to manage risk effectively. Diversification reduces risk and concentration increases the risk based on sectoral and industrial performance. Thus, a good mutual fund scheme have diversification across asset classes and sectors. Additionally, one should also evaluate the fund's historical volatility and risk measures. A fund with lower volatility and consistent risk management may be more suitable for conservative investors. Lastly, carefully reading the fund's prospectus and disclosure documents. Understanding the fund's investment objectives, risks, and any restrictions it may have will secure you from potential losses. Remember, diversifying your mutual fund investments across different asset classes and fund categories can further optimize your returns and reduce overall risk. By considering these key factors: 1. Fund's performance, 2. Expense ratio, 3. Fund manager experience, 4. Investment strategy, 5. Asset allocation, and risk measures, you can make more informed decisions when choosing the best mutual funds for optimal returns. If you found this video helpful, don't forget to like it and subscribe to the Growth Gurus.